again, thank you to everyone for taking out time to join us for this webinar. Today, we are going to talk about the global investment in private markets and the statutory landscape. And we have with us three esteemed guests for today's discussion. First, I'd like to welcome Mr. Kuntal Dave, who is a proprietor of Nanubhai Desai Co. So on behalf of the entire team at Kristal, a very warm welcome to you, Kuntal. And so Kuntal, just giving a quick background in terms of what Kuntal is looking into and what his experience has been. So Kuntal is an experienced chartered accountant with a demonstrated history of working across industries. He's skilled in many topics such as domestic taxation, international taxation, due diligence, tax advisories, merger and acquisition, both domestic and cross borders. A very warm welcome to you again, Kuntal. Glad to have you on board. We also have with us Mr. Manmohan Mall, who is the head of private markets at Kristal.AI. A warm welcome to you too, Manmohan. So Manmohan is an IIM Ahmedabad alumnus, and he's an experienced global investment banker. He has more than 18 years of experience across asset classes and geographies. Under his stewardship, Kristal Private Markets has launched more than 15 deals in last 1 year and is continuing to grow at a very fast pace. So welcome to you again, Manmohan. We also have with us another speaker from our team, Mr. Shailesh Shah. He's a senior advisor in private markets, and a very warm welcome to you as well, Shailesh. He's a seasoned professional with more than 8 years of experience in asset management, private banking, and economic policy advisory. So we look forward to learning more about global investment and private markets from all three of you. So thank you again, everyone, to join us for this session. So let's talk about a little bit about the topic. So of course, we all have heard about the immense opportunity and scope available in private markets. And there was a time when this investment opportunity was only limited to institutional investors. But with democratization of assets, we have witnessed an increased investor participation in the last few years. However, private market seems to be a little quite complex to all of us to decode and de-jargonize. So first, let's start with a quick poll over here in terms of gauging our understanding about private markets. So there's a short question on your screen. Would request everyone to participate in this poll and let us know whether you have invested in private markets before this or not. Okay, so clearly most of us have not invested ever in private markets, but we want to learn a little bit more about it so that we get a deeper understanding about how it goes. So Manmohan, we would like to hear from you in detail about private markets, what exactly is private markets and how it has shaped up in last few years. So over to you, Manmohan.
Thank you, Anjali. I really appreciate the opportunity and welcome everyone. So look, private market asset class has been fairly intriguing. As Anjali rightly mentioned, it's been an asset class which hitherto had been largely restricted to institutional investors. But number of players which have emerged in the last decade or so, including ourselves, wherein we, through our platform, we enable access to such harder to access, harder to understand asset class as private markets. So what exactly is private markets? Look, if you ask 10 people, I'm sure you will get like 10 different definitions of private markets. It is not fully and properly understood. So private market, in essence, is investment into any privately owned assets. These are by nature not publicly traded, and hence there's illiquidity into these assets. The information availability is a bit of a challenge, hence it is difficult to understand these assets. So example could be, let's say, if you were sitting in India considering investment into Byju's, which is a private company, that would be an example of a private market investment opportunity. If you are sitting anywhere in the world looking at a Carlyle private equity fund with any strategy, again, harder to access unless you meet a minimum investment requirement. Again, an example of a private market investment opportunity. And likewise, there are a number of other assets which will fit into the definition, including, let's say, real estate investment. Let's say someone sitting in India looking to deploy money into any commercial or residential real estate in the UK, that again would be an example of a private market investment opportunity. One can also call or label this as alternative investment, because this typically would not fit into your usual portfolio allocation, which will go into either, let's say, listed stocks, bonds, ETF, mutual funds, and so on. So fairly unique asset class, It has its own merit, and clearly the last 2 decades would have seen a phenomenal growth in terms of the AUM, which is getting managed under this space. Just to kind of share some numbers, just between like 1999 to 2008, one would have seen growth of the private market or alternative investment asset class from $1 trillion to $3 trillion. But ever since the global financial crisis in 2008, this particular asset class has witnessed a massive boom globally. So now we're looking at anywhere from, let's say, $10 trillion or more in terms of the total AUM for this asset class, which is a significant jump of, let's say, almost 3 times since the crisis in the last decade or so. What is interesting is last year itself, post-COVID, I would say still in the COVID era, but let's say the last phase of COVID, at least that's what we would like to believe. So 2021 witnessed a significant growth in this asset class, wherein we believe, based on some of the numbers that we have seen from research houses, that one is looking at almost like a $12 trillion mark, which is like 4x the size of AUM for this asset class compared to 2008. So it's an asset class which has been of interest to a lot of investors for obvious reasons. It provides the diversification, provides that alpha that you can generate in your portfolio. So overall, fairly exciting, fairly intriguing, harder to access, but nonetheless very relevant from a portfolio construct perspective.
That's phenomenal, really. So with such high inflows expected in this particular segment, it makes us think that how are Indians responding to these global investment opportunities in general, and not just for private markets? So Kuntal, we would like to understand from you how the trend has been in terms of the outbound foreign direct investments by India. So if you can just brief us a little bit more about that.
Yes, sure, Anjali. But first of all, thank you so much for organizing this wonderful webinar. And I'm so excited to be part of this panel along with Shailesh and Manmohan. I'm also here keenly to learn from them because I know they are also an expert when it comes to identifying a good investment opportunities. So I look forward to learning from them. And I'm happy to share my few thoughts on the subject. And as Manmohan and you have also rightly highlighted how this particular segment is getting more and more traction, is becoming more and more relevant as far as the HNIs are concerned, as far as the outbound investments are concerned. So if I was to, when you talk about trends, I would look at actually last 2-3 years period, to understand where we are today and probably understand in which direction the Indian HNIs or Indian investors would be looking at this opportunity. So when, we all went through this 2.5 years of lockdown, 2 years of lockdown, all the families, and I'm talking about entrepreneurs, I'm talking about wealthy families, it came out that there are 2 important things which every family will have to take care of. One and the foremost is family health, and second one is family wealth. We saw that life can be so unpredictable. We saw that because of a new disease and new pandemic, how it can create chaos as well as can create so much of difficulty for everybody. And we saw that because of that, health became a top priority for most of the families, which meant that they were very keen to understand where they should be having a good health setup, where they should be having a good setup so that they can protect their family members from such eventualities and they can get such support on timely basis. And health is linked to wealth. And we have seen that especially in India in last 2 years, I've seen that so many families who had for all the time I can remember kept their family wealth management or family wealth planning subject on a back burner. They felt that, I have some other pressing issues to take care of. I want to consider something else. And it always was kept on a back burner. But I saw the moment we got hit by COVID, in 3-4 months time, we started to hear from clients. They wanted to have proper strategy, proper planning to understand how well they can manage their wealth and how well they can have a wealth planning so that it can be passed on from one generation to another generation. And then naturally, when they come to making a decision, it gets influenced by every family's own typical setup, their own requirements. And then this two criteria of health and wealth has also played an important role in deciding where they should be residing or where they should be having more business activities, what kind of assets they should be holding, whether it is a need for them to diversify their asset portfolio, not only in terms of the kind of asset, type of asset, but also jurisdiction. They've identified that these are some triggering points. And this all has in fact led to two important aspects. One, we have seen increasingly all the HNIs and all the wealthy families going out and seeking advice from the councils, from the consultants, whether it is locally or outside of India. They would want to understand what are the opportunities. They would want to understand how do they minimize the risk. That is the one first visible thing which I could see. And second thing, which even numbers can support as far as India is concerned, there's a huge investments flowing outside of India as well. It is not only restricted to investments into India, but they have identified there are opportunities outside of India. At the same time, there is a need to have alternative investments which can give them support in such unpredictable future scenario where we are living at. And if you look from India's trend, I can just look into 2 months. I was just looking at RBI data for the month of December 21 and January 22. This 2 months data revealed that outbound investment from India is to the tune of $5 billion in 2 months period. So if you see from the point of a volume, and if you see from the point of view of how diversified Indians are and how they are looking at global opportunity, this number is an indicator. And out of 5 billion, 1.2 billion alone is under LRS scheme. As we know, LRS scheme is that liberalized remittance scheme where a resident Indian can take money outside of India for any purposes. So in 2 months, $1.2 billion have left India. So this shows that kind of investments which are taking place outside of India. So Indians have truly become global. Indians are truly looking at making investments outside of India. And this also suggests that this investment is not restricted to one asset class. They are having diversified asset portfolio. And this is, I think, trend which will continue. I think people would look at opportunities outside of India. And I think the platforms like Kristal is also going to play an important role to, one, educate Indian investors and to make them aware about the opportunities which are out there. Today, because of lack of that information, lack of knowledge, few investors who may have risk appetite may not be able to jump because they don't have information. They don't have any resource to understand such opportunities. And I think this trend may continue, even though there are opportunities in India, no doubt, like the way in which things are unfolding, one can expect there will be some allocation of investments into India as well. But I think to answer your question, trend, as I can see, is here for sure that people from India are looking to invest outside of India, and they would be very well serviced by platforms like Kristal to help them understand and help them identify investment opportunity. I don't know if answers your question, or I'm happy to, give you further information as we go along.
Definitely, Kuntal. It definitely answers the question, and it shows that Indians are investing into global investment avenues. And before we move ahead, I just want to know in terms of whether our audience is investing into outside of their domestic market. So there's a quick poll that we'll be doing. So there's a short question whether you have invested outside of your domestic market or not. And of course, a certain portion of the mutual funds or the ETFs that we are investing is investing into foreign stocks. Excluding that, if you have ever invested, so please choose your option accordingly. So clearly, most of us have not invested outside India or outside basically our domestic market. So it makes it more interesting for us to understand in terms of what are the different avenues, how we can invest, and of course, the structure, because that becomes a very important factor while we are choosing any investment option, which is not exactly located in our domestic jurisdiction. So Kuntal would want to get an explainer from you in terms of the different structures for such outbound investments and how does one go about it?
Yeah, sure. I think it's a very important subject. And in my experience, I've seen that families or the investors will be well advised to look into their own profile first. They will have to understand their own needs, their own preferences, and also their profile of the family members, which would be a very important criteria or parameters before concluding a structure. There can't be one structure which can be applicable to all. Also, we have seen in our experience, there are various individuals who may have their own preferences. For example, a simple thing like, you may have an individual who is resident in India, for whatever reasons, would not want to disclose in his income tax return that he is holding a foreign asset, legitimate foreign asset, done under the four corners of the law, but still he has his own preference that I don't want to disclose that I am holding a foreign asset. That nobody can question why that is that choice or that is a preference or that is how it is. Then for him, you can't use LRS, because the moment you use an LRS structure, it would get reported into your income tax return, but you don't want to do that. So for them, it could be other structure. And similarly, there would be somebody who may be averse to corporate structure. They would not want to get into this kind of layers, or having a beneficial ownership requirement, or having some kind of a different tax system. They may not have a good back office admin team. They would like to keep it simple, that I'll invest in my name, I'll earn in my name, I'll pay taxes wherever in my name. So then for him, he would go by LRS over ODA. So looking at the preferences and looking at the family background of the investor, one will have to identify right structure. Broadly speaking, as I mentioned, under the Indian regulation, an Indian investor can look at two broad structures. One is investing individually under LRS route, which is liberalized remittance scheme. And second would be under ODI route. And there can be also mix of both, depending upon the type of business which the individual is, the kind of activities which individual is trying to pursue, and also the quantum of money which they want to take outside of India for the given defined economic purpose. So depending upon that, it can be either under LRS or it can be under overseas direct investment, which is a route where an Indian company will invest outside of India. And to do this, again, there are certain factors which will play a very important role. One, most important, is the domestic law of India, because the domestic tax law will decide how your income will be taxed. Second would be whether there are any tax treaties which India has signed with the other country, which can be useful as far as the minimizing the tax exposure is concerned. I may not go and list down each and every entry, but I'm just trying to give a flavor of what all factors one will have to keep it in mind before getting into a right structure. For businesses, there can be also need to look into a bilateral investment treaty, because they would want to understand that their investment is protected. Same way, for many individuals having a bank account in a foreign country, they would want to have some kind of insurance. They would want to have some kind of certainty. Again, that will play an important role. Where do you open that bank account? Whether you want to open in Singapore, whether you want to open in Switzerland, because every country will have their own banking norms. That is also another factor which you have to find out. And then when you're setting up a structure, for example, what will also be important is that how would you want the surplus or income of your activities being distributed amongst the family members, and where those family members are, and how would you want to do it in a very tax efficient manner. So broadly, I think it would be a tax, something which you need to keep in mind. So tax consideration, regulatory consideration, because depending upon the structure, different regulation will have a different play, and a commercial factors which will play an important role. So combination of this will throw open some good option for the investor, and then having it cross-checked with the advisor at a foreign jurisdiction will give you a comfort to proceed with your foreign investment. But all this said, I can only make one overarching statement, that things are not difficult. Things are easy. It's not that you are going to reinvent the wheel. Everybody now has such structures. So it should not be something where we should be quite worried about this whole exercise. But you need to meet with the requirement of the law.
Thanks, Kuntal, for explaining that. Before we move ahead,
Anjali, if I can just add to what Kuntal just explained, I think that's all a number of very good points that you have made, Kuntal, and I think there's some interest from the audience as well in terms of the two routes that we explained, LRS versus the ODI. And I'm sure there will be associated complexities around something like ODI, but LRS, based on our own experience, just to share, has been a fairly smooth process. So what may look difficult sitting in India in terms of, how do I access an asset which is unlisted in the market like US, or let's say some sort of a real estate exposure in a market like UK, all that may look very complex. But thanks to all the efforts from the central bank in India, and again, many such institutions in their respective jurisdictions, the whole entire process of being able to make international investment has been really made fairly straightforward. And that's where I think not just us, we obviously are in the process of democratizing the access to such investments so that people sitting in different geographies, including India, are able to kind of access assets like SpaceX. I think it was mentioned on the chat as well, in significantly smaller sizes, let's say 25,000, 50,000 US dollar, and then people can get access into one, harder to access as well as harder to understand assets like let's say Klarna, which is largest buy now pay later platform out of Europe. But from a regulatory perspective, especially for the LRS route, the entire mechanism has been really made fairly straightforward. In fact, the transfer of money from India to, let's say, overseas account that is required for deployment into the target asset, even that has been really smoothened. In fact, our own KYC process just takes like a day or two, and then the entire LRS remittance is again just a matter of a day or two. And so from start to finish, people can actually make investments into targeted assets, let's say within 3 days' time, which I would say until recently would have been very difficult for people to even imagine. Now it has become all very much within the reach of the investors. Actually, anywhere in the world, most of the countries developed or emerging, and certainly in India as well. Over to you, Anjali.
Sure, definitely. So before we move ahead, there's a question on taxation. Then probably Kuntal can you take it up? So basically, our audience wants to know that how does taxation work for international public and private markets, and is there any concept of long-term capital gain for such investments? So Kuntal would really love to hear from you on that.
Sure. So taxation or the tax incidence will depend first of all on the residency of the investor or the taxpayer. So if you are going to be resident in India, you will have to pay tax in India on your worldwide income. So income may arise in India, may arise in Singapore, may arise in Europe. But since you are resident in India, you would be liable to tax on that income in India. And then it would be as per the tax rate which is applicable to you under India. So depending upon where you fit in the slab rate of taxes, you have to pay tax on that particular amount of income which you have earned outside of India. And because you are resident in India, and if there is a good tax treaty which India would have signed with the foreign country, then taxes, if at all you're paid in that foreign country, will also be available for you to offset against your tax liability. So if you have a tax liability in India of say 100, and if you have paid a tax of 30 in say Singapore, then you'll have to pay tax in India of only 70, because 30 paid in Singapore will be available to you as a credit. Now, tax liability at Singapore or tax liability at any other country will depend upon that country's law. For example, Singapore may not tax you on capital gain, but it may tax you on dividend income. Again, there is a tax rate which can be only 22% in Singapore. So depending upon the income which you earn in a foreign country and the taxing rule of that foreign country, you'll be subject to tax in the foreign country as well. And as far as you are a resident of India, you'll be able to set it off against your Indian tax liability. Now, the same holds good if the investor is a private limited company. Then private limited company will also be subject to taxes in the Indian context as well as outside of India, and you get a credit. So I hope this gives bar and wire some overview of how the tax system works.
Definitely, yeah. Multiple people have been asking this question, if you can substantiate more on the ODI route. So Manmohan already briefed us about the LRS route. If you can just touch upon on the ODI route, please.
So ODI is a short form for overseas direct investment, which is a route which has been opened up by the RBI or central government for allowing Indian companies to carry out their activities outside of India. So if you are carrying out some specified activity in India, you can carry out similar activities outside of India as well. And for that, you are allowed to take out of the country up to 4 times of your net worth into the foreign jurisdiction. So you are in India doing, say, for example, manufacturing of steel, hypothetically, and you want to set up similar activity outside of India. And if your net worth in India is $100, then you can take out up to $400 into the foreign country to establish that particular setup. So that's something called as ODI. There are certain restrictions. For example, you can't do gambling activity, or there are certain prohibited activities which you can't do. And also you can't do financial services under ODI route without seeking approval from Reserve Bank of India as well as from the foreign regulator.
Sure, Kuntal. Manmohan, you touched upon the LRS. There's a subsequent question on that. One of our participants is asking, if we invest through Kristal using LRS for capital gains, do we need to pay as per the tax slab? And is the investment considered to be done from Singapore?
Yeah, look, a very relevant question. And again, not the first time that we've come across this, but taxation obviously is a bit of a complicated matter. And it's always, we encourage people to take their own tax advice, considering the entirety of the situation. So your own residency, where you're putting the money, under what structure you're kind of putting the money. But very generally speaking, and also kind of touching upon one other question which was highlighted from a regulatory perspective as to which is the regulator for, let's say, investment into a US unlisted asset. So look, I think a few things. The way we operate is we are licensed and supervised by the regulator here in Singapore, which is MAS. So any investment made through us obviously has a regulatory oversight of the Singapore authority. Then depending on the target assets jurisdiction, be it the US or Europe or let's say even Singapore, that asset obviously would need to kind of be governed by the respective regulatory authority there. Generally, unlisted assets are not heavily regulated by the regulator in any country, but let's say if there's an IPO that takes place, then all those considerations would be specific to the country where the asset is getting listed. So if you're talking about a SpaceX, which eventually will get listed on the US market, that will be governed by SEC. It will have nothing to do with SEBI. But likewise, let's say our investors would have come in and invested into, let's say, Byju's or Meesho. Eventually, if they do get listed in the Indian market, that will be subject matter of SEBI's regulations. On the taxation bit, look, I think depending on your residency, you will be subject to the taxation as per the rule of that country. In the India context, yeah, as Kuntal also clarified, irrespective where the assets may lie, any gain on that asset may be subject to appropriate tax in India. And again, the holding period for long-term versus short-term may vary. So just again, more of from an education perspective, for any listed asset, typically that holding period is 12 months. As against that, any unlisted asset, the holding period requirement is 24 months before it is eligible for long-term capital gains tax. So again, I would really urge, while these are all very pertinent questions, very relevant, and we have come across this number of times, but again, we were not tax advisors, so we would not kind of, necessarily suggest or make any suggestions here. Really appreciate if you can take it up with your tax consultant.
Thanks, Manmohan. Thanks, Manmohan and Kuntal, for clarifying all the taxation-related issues. Coming back to the topic that we were discussing, if we talk about private markets, not just Indians, we have seen increased participation from investors across the globe. But when we talk to a number of clients from a portfolio construct perspective, they often say that a basic 60-40 portfolio, basically having a 60% equity and 40% of a debt in the portfolio, has performed quite well as compared to cash. So in that case, we would like to understand from you, Manmohan, in terms of whether private markets or alternatives in general are really worth the effort. And if so, what should be the ideal asset allocation one should be looking at?
Absolutely, Anjali. I think that's something which I'm sure will be top of mind of all the the investors, including the members in the audience as well. So look, I think there are enough studies which have been undertaken. We're happy to kind of, maybe quote one which was undertaken by Mercer recently, wherein they looked at a 10-year return performance between a portfolio of 60-40 equity fixed income assets over a very long period of, let's say, 50 years over cash. And again, as one would expect, the outperformance was pretty significant, almost like 10.5% outperformance over people just holding on to cash. So that, I think, is fairly well accepted in practice as well. So no big surprises there. The new thing is, if that is all good, then why consider private market investments? Again, enough studies which have been undertaken. And again, to quote another study, so there's a study which was taken up by Cambridge Associates at some time, and wherein they looked at the performance of private market funds versus, let's say, the public market funds, or let's say use S&P 500 as a proxy for that. The outperformance for private market, let's say between 2000 to 2021, last 2 decades, would have been significant year on year. So it's almost like 5 percentage points better than a public market fund. What is tricky is what should be the right allocation for such private market assets, because it's not that they are devoid of any challenges, and we will obviously go through the challenges later on during the session, but they do provide that diversification and also potential to create that alpha wherein you can beat the market by taking private market exposure. And some of the studies, as I just mentioned, one of the studies clearly showed outperformance by almost like 5% year on year compared to public market investment. In terms of allocation, look, there is a bit of a science behind it, and that probably would bore a lot of people. But I would say anecdotally, people would have seen the allocation to private market assets or alternative assets varying from country to country depending on investors' appetite. So if you look at certain countries wherein the investor appetite is a bit more lower, bit more conservative style of investment, that allocation would tend to be lower. So it could be around, let's say, 5-10%. But in general, again, studies would indicate that one can consider anywhere from 10 to 20% allocation to alternative asset class. And that has consistently yielded pretty healthy risk return profile for the investors globally. But in general, one would see, if one were to take a global average, anywhere from 15-20% allocation to alternative asset class.
That's really interesting. But as lucrative as it may sound, we know that there are multiple challenges in private markets. So I would like you to explain a little bit more about private markets and how can one overcome that. But before that, I'll just do a quick poll in terms of seeing what our audience feels about this question. So let us know about the biggest challenge, according to you. What is the biggest challenge in private markets? Okay, so majority of us feel that there's not enough information on the available assets. But of course, other challenges also being equally important, and we all keep facing that. So Manmohan, I would like to understand about these challenges from you.
Yeah, no, absolutely. I'm not surprised by that response. Absolutely. We as a platform who tend to specialize in this asset class, again, we have to deal with the same set of issues as any other investor would do. So look, the challenges, as very rightly noted by the audience, is exactly that, wherein the information on these private companies would be very hard for anyone to kind of access. These are private companies, so they don't have any regulatory obligation to kind of make the disclosure, unlike a public company, a listed company, which obviously would be reporting it to the exchange, reporting it to the authorities, and so on. And there are like tens of research analysts covering those companies and coming out with broker research report and so on. That luxury, unfortunately, we don't have in any of these private market investment opportunities. And again, as I said, private market is a very broad term. But let's say if we stick to investing into unlisted private companies globally, that problem would be there everywhere, wherever you look at in terms of geographies on the unlisted assets. With a very, very few exceptions in some European markets, wherein some companies voluntarily may disclose a lot of information, like Klarna is a classic example. It's a private company, but yet they have their annual reports out in public domain. But nonetheless, pretty much, I would say 95% of the companies would really come out with a lot of information for people to make an informed decision on. And that could be in India, could be anywhere in the world. The second one, which again was very rightly pointed in that poll as well, is the pricing level, right? So there is no clarity in terms of what is the exact valuation where the company should be trading at. It's a OTC market. You could say that Byju's is valued at $15 billion. I could say I'm comfortable taking a stake at $10 billion valuation. You could be right. I could be right as well. It's harder for anyone to kind of give a specific price point. But again, with increased activity in the private space, both onshore in India as well as offshore, wherein outside investors are constantly looking at opportunities to deploy capital in Indian unlisted companies, and likewise, wherein outbound investment from India to, let's say, assets in the US or Europe has increased significantly. That price discovery is getting better, but definitely nowhere close to the public market transparency that you see. The third point, which really bothers a lot of investors, is the illiquidity. So while if you take exposure on, let's say, Reliance Industries or ITC today, and you don't really like the investment story tomorrow, or let's say even next second, you can actually exit. That's not the case in terms of the private market investment. There is significant illiquidity which comes attached with these investments. And again, on a best effort basis, we try and generate liquidity for our investors who come and invest into these assets. There are quite a few other challenges, and one last challenge that I'll highlight. Let's say you are sitting in, let's say, Chennai, and you think that Misho is a great story because you have come across that name, how that is making a difference to entrepreneur's life, and you want to take a exposure into that asset. How do you go about it? It's not easy because, again, unlike public market assets, wherein you could just call up your broker, participate, even let's say in $100 or 10,000 rupees, whatever that amount may be, it is very difficult for anyone to kind of very readily tap into a private company for the very reason because these are private, and especially when you're looking to deploy smaller quantum of money into these companies, even harder to kind of access that. Again, that's where a platform like ours come into play, wherein given our slightly superior access, we do have opportunity to kind of invest into these companies, both on a primary basis as well as a secondary basis. Then our investors can come in and significantly smaller ticket size, again, depending on the type of the transaction, that could be as small as $25,000 per investment. But in those smaller quantums, we do enable investment into these companies. So look, I think challenges are plenty, but with the market maturing, with more and more companies kind of staying private for longer time, people are finding avenues wherein it becomes easier for people to kind of participate into these high growth investment opportunities. And again, lastly, I think there's some question as well around fund. So either you can take exposure into these companies on a single asset basis, or there could be opportunities to take exposure in this asset class in a fund format, which gives you a diversified portfolio exposure to this asset class. So again, there could be options on both the sides. We as a platform obviously enable access into this asset class, both in a single asset format as well as in a fund format, wherein people can take exposure into a diversified portfolio of assets. Absolutely. I hope that clarifies eventually.
Yes, definitely it does. But I think apart from the challenges that you have mentioned, I think understanding the regulatory aspect also becomes quite critical but complex for an investor. So Kuntal would like to get an explainer from you in terms of the relevant regulations in India that one should be looking at.
Yeah, sure. So regulatory understanding is definitely very important because last thing you want is to get caught between the regulatory's review and you come across some defaults. You don't want to do that. So principally for a resident Indian or Indian investor looking to invest outside of India, looking at Income Tax Act, surely because that's going to be an economic activity giving rise to an income. There can be also applicability of Indian Companies Act if you are doing under a platform of a company. And naturally, then Foreign Exchange Management Act, because any transaction by resident Indian in a foreign currency would be governed by the provisions of Indian Foreign Exchange Management Act. So this is one set of regulations when we are talking about private market. And similarly, the other set of regulations would be the home jurisdiction or the target jurisdiction where you are looking to invest your funds. If you are subscribing to a fund outside of India, then you need to be clear that how you are meeting with the KYC norms of that jurisdiction, or what kind of declaration you need to give to that jurisdiction. So that is another set of regulations which you need to take care of. And combination of all the right ticks for the applicable regulations is something which will be necessary for investors to invest outside of India. But this is not something complex, because today, knowingly or unknowingly also, every investments by Indian resident into Indian market is also getting governed by laws, is also getting covered by regulations. But there are systems in place, there are processes in place. So it will ensure that when you embark into an investment activity within India, you will be sure that you are on the right side of the law and you're compliant with the regulation. And similarly, when you're looking at investing outside, if you follow the right process, the right steps, you will be able to meet up with the regulations. So Income Tax Act, Companies Act, FEMA from India, and jurisdiction, target jurisdiction laws, Income Tax Act and other regulation will be important for the investor to factor this particular opportunity of investing outside of India.
Thanks, Kuntal. So now coming back again to the topic of private markets, there's a quick poll that we want to do. So let us know if at what stage would you prefer to invest in a high growth company? Would it be like seed early stage, late growth stage, pre-IPO, IPO, or maybe you directly want to buy it through stock exchanges once it's public? So I think a lot of our audience will choose in the private market space rather than investing in a public company. So that's really encouraging to hear from our side. So I'll hand it over now to Shailesh, who will take us through some specific examples, both from Indian and global contexts. So over to you, Shailesh.
Thank you, Anjali, and hello, everyone. It's really interesting to see how the poll results were like. And I think all of us here, at least people who are voting, understand the benefits of diversification, 30-30-30 on each of the different stages. And that is, I think, a very correct approach to take, because there are opportunities for private market investment, both in the late stage, pre-IPO stage, and also in the early stage. And there are, dependent upon how you approach it, very good, I would say, upsides to it. For instance, one of the very famous private market investments was what we call Facebook today. In 2011, Goldman Sachs basically offered its private banking clients an opportunity to invest in a company which was supposed to be going public soon, but that its CEO was not very interested in going public because he wanted to control a lot of the company. So the thing was, if you invest in this company at this point in time, you cannot dilute your stake for next 18 months. A lot of people thought that why would we invest in such a company, because it's only $50 billion. How much more growth is going to happen? The model was not very well validated, but there were a precious few who did. And within 18 months, the company was worth $140 billion. So it was already a 2.8x gain. Facebook is one of the many stories of that sort. So why I'm trying to talk about this is that there is a certain class of companies which will always be what I like to call reluctant giants. They will always remain in the private sector. Like, I don't think any of us have invested in a company like Carlsberg or a company like McKinsey. And all of these are private market companies. We have heard about them. In India, you have heard of Haldiram. But all of these companies are very high growth private market companies. The reason why they are not going public could be many. Like sometimes, some founders think that, and Richard Branson was very open in talking about it, that investment bankers can't tell our story and hence will not get private market value. Some people say that, oh, we have enough cash and we want to invest in R&D. If we go to public markets, there will be so much short-term pressure that we can't develop products. A good example of that is a number of food, beverage, and beer companies. In fact, a lot of vineyards and wine companies globally are private. So it could be something like McKinsey, where partners hold so much stock and senior people hold so much stock that they can't go public. But it doesn't mean that there isn't growth there. There is a lot of growth there. And that kind of opportunity can only be accessed in private market. And these are companies which will have characteristics and risks much lower than what you would think would be like for a early stage investment. So that could be one addition to your portfolio. The other addition to your portfolio would be a company like Byju's, where, you know, if you invested, and there was a very famous Indian family office which invested about 200,000 or 400,000 between that capital amount at $20 million valuation. And today it is 1050x the valuation even before the last round. And it is very interesting to note there that, you know, there is another approach to private market investing, is that a lot of companies, when they see the biggest jump in their valuation, when they make their first product, when they land their first customer, and when they are into the first new market of geographical expansion. All of these phases in the life are like, you know, the phases in the life of a human being. If you talk to any doctor, they will tell you that most human beings will learn the most amount of things in the first 10 years of their lives. So that's the kind of investment that you are doing when you are doing investment in early stage things. And how do you invest in that? There was a very interesting investor, Charlie Ellis, who found Greenwich Associates, and he's also behind this. He was also on the board of Vanguard and Yale Endowment, which is probably one of the most successful LPs or institutional investors in the world. What he said is that early stage VC is basically human resources. Like a human resource manager, you should be able to find the right founder. And if you're able to find the right founder, you'll be able to coach them. So these are a few success stories that I see can inform your approach. One approach is to understand that, you know, there are a lot of companies in the late stage which are worth investing, and to do that investment, you probably go take the risk, take the entire bet of investing with the best. Meaning, investing with the best is basically you look at companies where large marquee investors have put in their money, and you just, you know, put side bets with them. The other way is to probably invest like an HR manager, find people you like, people you believe in, do a lot more, you know, face-to-face meeting with the founders and invest in them. So there is no single playbook in this market, as there is no single way of, as there is no single class of private market investments. Some of them are young and some of them have very different incentives for remaining private. So yeah, these are some of the ideas that I had to share. Over to you, Anjali.
Sure. Thank you, Shailesh. Moving on, let's take up some of the questions in the chat box and the Q&A. So Manmohan, a little off the topic, but one of our participants would want to know the way we pick stocks, commodities for investments, and do we use fundamental analysis or technical analysis? I'm sure this is more relevant for the public market, but if you can provide a view on both public and the private, both from a Kristal point of view.
Yeah, absolutely. As you rightly pointed out, Anjali, I mean, typical technical analysis, which is the analysis of the price movements, would apply to a public market asset for the obvious reason that there are price data which are available for such assets, right? We don't have that luxury for private market assets, while there would be some data which would be available around, let's say, last round valuation or some secondary transaction that we could be aware of, but that's not enough for anyone to do any meaningful amount of technical analysis there. So it is largely driven by fundamental analysis around the, as Shailesh also pointed out, for very early stage companies, around the founders, who are the people behind, who have the vision, the passion to kind of, you know, get it to the next level. And for slightly more advanced, mature companies, be it in the growth or late stage pre-IPO, that would be through the market that they would have acquired, their top line, not necessarily their profitability, because most of these companies are not very profitable, but how quickly they have actually acquired the customer base, or the top line, how that has grown, and obviously closer to the IPO, how their profitability or EBITDA numbers are kind of, you know, coming up. All that would determine the investability of those assets. So it is more fundamental driven rather than technical data analysis driven. But again, at Kristal, we look at both the public as well as the private market. Public market would obviously rely on both a combination of fundamental as well as technical analysis. Private market significantly based on a lot of effort put in by the team around screening the right assets, talking to a lot of investors, talking to the investor community, depending on what they are looking for, and then try and see what asset probably could make sense for investors to consider.
Definitely. There's another question about one of the very hot topics everybody is discussing these days, about how would the market get affected by the current war being declared between Ukraine and Russia. And since the stocks are already going down, do you think it's going to affect the market? And is it going to be significantly different from the way the pandemic had affected the market?
That's a tricky one. So thanks for asking that question. But look, I think it is still early days and not very clear in terms of how this will progress. The war is on as of now, and we are seeing that getting reflected in the markets globally. So Sensex was down 5% when I checked last, and I'm sure similar reaction would come up on all markets globally, and again reflected on the commodities and oil prices as well, which has crossed $100 after 7 years. So look, I think it's still early days. There would be significant impact. It remains to be seen exactly how meaningful that impact would be, and again, how the course of this assault progresses. So early days. But Kuntal, if you had any views on this topic, which is again fairly hot right now.
No, I would have loved to give some thoughts, but that would be just my personal belief, because I'm not as good as you when it comes to investment advisory matters. I'm a tax advisor, but I also in a way feel that these are early days, and we can expect a lot of turbulent market as we progress. Hopefully, diplomacy should come into play, and we should see that this tensions are diffused in near future.
Thanks, Kuntal. Thanks, Manmohan. Manmohan, there's another question from the resident Indian point of view. So he's asking basically for resident Indians if we plan to invest in Indian unlisted companies. So investing through Kristal will go through the round routing, or will there be any regulatory challenges on that front?
So there would be, look, so very pertinent question. The way we are structured, we operate as a fund manager out of Singapore. So any investor money coming in from India and then let's say ending up into an India incorporated company would tend to amount to round tripping, and we do not do that. It's not permitted under the regulations right now. So any money coming from India is for overseas assets. But given we have a client base spread in 20 countries, so for Indian assets right now, given the structure that we have, it's all offshore money that gets routed into India. We are working on some structures and solution which would allow us to kind of offer these Indian investment opportunities to Indian resident clients in a rupee structure. Then obviously it kind of takes away the FX risk as well as any regulatory issues in terms of getting the money out of the country and getting it back into the country.
Thanks, Manmohan. There's another question, probably half of it you have already answered in terms of the due diligence being done by Kristal team. But one of our participants would want to know more about it. So he's asking basically due to limited disclosure, illiquidity along the asymmetric information, extensively due diligence and connection in the private market community becomes essential to evaluate an opportunity. So what level of due diligence is being done by the Kristal team? So would you like to elaborate a little bit more on that?
Yeah, I would love to, but also conscious of the time as well, Anjali, because we just crossed the scheduled hour. But so look, very quickly, and maybe we would love to have this conversation separately in a smaller group on one-on-one as needed. But there is extensive due diligence to the extent it is practically feasible done by the Kristal private market team, wherein again, through our own understanding of the assets and the sector, our conversation with the industry participants, the VCs, in some cases directly with the companies and the founders as well. So there is significant amount of work which is done and also shared by the team with the investors, either through research papers that will be generated or through webinars or one-on-one call with the investors and so on. So there is a significant amount of work that is done. But again, compared to the public market, you will realize that there is not enough data that is available, but that's a shortcoming of this asset class. So a lot of times people will go with their own preference around sectors and investments or founders that they want to back. So let's say a SpaceX, whatever it is worth in terms of the fundamentals and so on, obviously has a huge amount of fan following because of Elon Musk effect, right? So every investor has got a different way of looking at investment opportunities. So it will take a combination of a few things. We try and help and enable slightly more informed decision making, but I would not say that we have access to information which is significantly more than what, let's say, you as an investor would have. But just we try on a best effort basis to put together some investment story and share with our investors.
Right. Yeah, absolutely. So just one last question I would like to take in terms of, of course, the tenure of investment would depend on asset to asset, but there's a participant who would want to know about the typical tenure of investment in private markets through Kristal. So can you touch on a little bit on that?
So very quickly, and thanks for that question, Prasanna. I mean, look, the reality is depending on what stage of the company that you are kind of targeting. So if it is a late stage pre-IPO company, and again, depending on the market circumstances, that tenure could be really short, anywhere from, let's say, a year to 3 years, typically. Let's say Grab, we did in late 2020, and our investors had an exit late last year. So within 1 year, they had an exit on something like Grab. But that was a function of Grab getting listed on the US market through SPAC. But typically, I would say a 2 to 3 year time frame for a late stage asset. And for a growth stage asset, that could be, let's say, 4 to 5 year, and a very early stage company, as Shailesh rightly pointed to, be it, let's say, a Byju's at $20 million valuation, or many other companies which exist right now, that could be a much longer investment horizon, anywhere, let's say, anywhere from 5 to 10 years as well. So it's entirely a function of what stage of growth the investor would want to kind of come in at.
Right. And the minimum investment ranges somewhere like 25 to 26K, in dollar terms. That's usually the minimum investment size from Kristal Private Markets. There's another question, Manmohan, in terms of, and very rightly pointed by Rahul over here, that because of the dozen failed startups, it becomes even more critical to diversify your private markets portfolio. So in your opinion, what should be the allocation to a single opportunity would be if the person is having $100 as the investable amount?
Yeah. Absolutely. A great question. So look, I think, let's say if you at your level want to take exposure to alternative asset class to the tune of 20% of your total investable asset, right? So out of that 20, I mean, you can achieve diversification at your own level, despite the fact that you are participating or taking exposure in single assets. And that's very simple. There is not too much of a rocket science behind it. So if it is a $20 million out of $100 million that you have, I'm just using this number randomly, but just let's use it at 100 is what you need to deploy, 20 going to alternative asset class. Then out of 20, if you can have 10 to 20 assets that you're taking exposure on, and that could be a combination of unlisted assets at different stage of their growth, or let's say a real estate or a private equity or whatever, then a combination of these would probably aggregate to 20, would be, I would say, ballpark average that you would see from participants globally. So you can have 10 to 20 of these assets in smaller sizes, aggregating up to a certain amount.
Thanks.
Or again, the easier way could be, you leave that asset selection process to a fund manager and participate in these growth stories by coming into a fund which could be managed by appropriate fund manager. I mean, so again, on our side, as I mentioned, we do provide access to single assets and also exposure to this asset class in a fund format as well.
Right. We would have loved to take other questions, but mindful of the time, Manmohan, would you like to conclude with the remarks from your side?
So I'll keep it very, very brief. Again, really appreciate all the time and the interest shown by everyone. Thankful to Kuntal for taking the time and really touching upon some very critical aspect with regards to these private market investments in the Indian context, all the rules and the taxation aspect around it. So look, I think it's a fairly interesting asset class. harder to access, difficult to understand. But in our endeavor, by bringing in, I would say, the industry and the company knowledge, by adopting new technologies like blockchain in terms of our execution, being governed by regulators in pretty much every country that we are present in. So Singapore, Hong Kong, India, going into Dubai as well. So all those things probably would give the user comfort in terms of dealing with a partner in order to kind of access these investment opportunities. So as I said, really excited to continue to share more, but very mindful of the time that we've exceeded now. But if there's any follow-up question, more insight that we can share, very happy to kind of connect in a smaller group or one-on-one.
Sure, Manmohan. There's just one last question we want to take from Kuntal, wherein is there any circular that allows Indian residents to participate in private markets? So Kuntal, can you throw some light on that?
Yeah, so the RBI circular on investments by resident Indian under LRS route is a very self-clear declaration. For any purpose, you can invest outside India. So you don't need a specific mention in the circular that you can invest in private market. So you can use for whatever purpose you like.
Great.
So it's an all-encompassing permission. So it gets covered in that circular itself.
Okay, great. Thank you so much. So thank you, Manmohan, thank you, Kuntal, and thank you, Shailesh, for enlightening us today on the various aspects of global investments, private markets, and taxation. And thank you, everyone, for joining us on this webinar. There's a short survey coming your way. So would request everyone to spare just 10 seconds of your time and fill out that survey. It will help us understand how we can serve you better. And do leave us your email ID in case you want to get a follow-up document on this webinar in terms of a presentation or quick insights or the webinar recording. So we'll be happy to share that with you. So again, thank you so much to all the speakers and all the participants to join us for this webinar. Have a great day.
Thank you. Thank you so much. Bye-bye.
Thank you.